Actually, one thing I would add to that is that a lot of that is actually existing data center getting more efficient by transitioning old x86 chips to new ARM chips. Welcome to the Telltales podcast, where we discuss cash flow and its pivotal role in investing. I'm Mike Nicoletti.
And I'm Jason Wallace. Along with our co-host Hunt Lawrence, aka Mr. Cashflow, we're here to explore how cash flow drives the economy and investment performance.
And don't forget to join our email list at telltales.us to get the cash flow memo. It's about 20 pages covering 80 companies, U.S. government's finances, and the energy sector.
It's like having a masterclass on investing in your inbox every week.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
I'm going to get through C, B, and A pretty quickly. On C, I always need to report that there's 4 million barrels of extra production. And if most of that's with Saudi Arabia and the UAE, if that came on the market, the price of oil, pick a number, it could be $60, could be $50. I don't think they're going to do that. But the risk premium, the remainder of the risk premium, depends on Ukraine and the Middle East. And both places may be calming down. I mean, Zelensky now is saying that he has a plan in front of the Biden administration to make a deal with Russia, and he wants to discuss the plan with Kamala Harris and with Donald Trump. So maybe he's way overstepping whatever he thinks he can do with the Russians. But if the Ukraine calmed down, that would not be good for the price of oil. With regard to Israel and Gaza and Hezbollah and Iran, the latest raid by the Israelis to try to eliminate as many rocket launches as possible, and the subsequent firing of rockets and drones, which, didn't really cause any real difficulty in Israel. It looks to me, or it's conceivable, that Israel and Hezbollah have some kind of a working relationship here, which will not result in Israel pushing all the way to Beirut, and that Iran is supporting that. Iran has said that their response to Israel, or their revenge for Israel planting a bomb in the closet of this high operative of Hamas, who, on a guest house on the government property, is, they're postponed. They remember, but they're going to get to it later. I'm just a little worried about the price of oil as things possibly calm down in both places, but we'll see. On the U.S. gas supply, Exhibit B, the November contract is starting to trade like in the low twos. That is not very good. I mean, what has happened here is there's too much gas in storage. We added, based on these numbers, 3 Bs a day, or a trillion feet of gas in storage last year. That's almost impossible. And like 300 Bs this year with a trillion 3. And I think what market participants are worried about is to have the Henry Hub price turn out to be like the Waha price. The Waha price, which is gas in the Permian, has been trading at under in negative ground. It just can't seem to even get into positive ground. So I can see so your city gate prices in Chicago are less than your Henry Hub price. So will early cold weather fix that? I hope so. But to have the November contract, I think a few weeks ago was $3. Now it's in the low twos. That's not good. Exhibit A, at least my Exhibit A, now has 25 on it. I apologize for last week where 25 was cut off. But there is no answer here for the deficit other than to work out of it very slowly. I saw an article in the paper this morning about Kamala's tax bill or tax program. It's to raise about as much money it's not to raise new revenue, it's to have additional tax higher individual income tax, higher corporate income tax, taxing unrealized gains for people worth more than 100 million, more tax credits, especially child tax credits. So who knows if they're elected, what they'll be able to do. A lot will depend on who controls the House, who controls the Senate. We have to consider that the Democrats last time tried to get rid of the filibuster, and two of the people that caucused with them were Democrats. Manchin and Sinema from Arizona wouldn't go along. But if they hold the Senate and they're in control of the House and they end filibuster where you need 60 votes to get anything done, you could have some pretty significant tax changes. With that, just gonna stop to see if Mike or Jason have anything to add.
No, but this sheet has inspired us to, out of curiosity, create one for California. So
Yep.
we haven't done that, but we will.
Excellent. I've been promising the last few weeks, especially when we had the girls here who have gone back to school or started their freshman year, both at orientation. We had to reserve 5 minutes for them, and we really appreciate it. They're listening. We really appreciate their efforts. I've been saying that I review the energy sheets. I think I can cruise through them here in about 5 minutes before we get into NVIDIA and everything else connected with chips and software. Page 12, starting from the back, is the first energy page. Antero, EQT, and Chesapeake. These are all very good companies. My favorite's Antero because we helped start it. We've made a great deal of money from it. EQT is somewhat larger, also Marcellus, all Marcellus. Chesapeake is kind of half Marcellus and half Haynesville and Bossier. These companies are cheap, but they could get cheaper if gas really misbehaves. They've got their debt in order. They do have free cash flow to cover their capex. So, they're worth buying, but you may get them cheaper. Between Antero, EQT, and Chesapeake, I have a slight preference for Antero, EQT. I just think the Haynesville, if gas prices are going to be persistently low, is much more vulnerable than the Marcellus. The next page, page 11, is EOG, Magnolia, Permian Resources, and Diamondback Energy. The two that I think are performing the best here are EOG and Magnolia because neither one of them has any debt. You can see Permian Resources, which is a relatively recent company put together, does have almost $4 billion of debt, and Diamondback, which is very aggressive in trying to consolidate in the Midland Basin, Midland Subbasin, the Permian Basin, has $6 billion of debt. I just like the companies without debt. Neither EOG or Magnolia will overspend there. In other words, they will always have free cash flow. The key question is, will they have free cash flow and be able to have unit production growth? And they did pretty well last year. Both EOG and Magnolia grew their production 8%. I think they're both predicting this year and into next year that that's going to slow down. But still, it's a very good performance. If Ukraine got quiet and the Middle East looked like it was quieting down, would you get these things cheaper? Probably. Is there the prospect of a fly-up in oil prices? Hard to see with that extra 4 million barrels of surplus capacity. These are great long-term holdings. The cheaper you get them, the better you'll do. So probably the thing to do is to sit for a while longer, or if you own them, you should be comfortable holding them. The midstream companies have somewhat less commodity exposure, but they all have a great deal of debt. Unlike EOG and Magnolia, they weren't able, since they have distributions and since they have fairly high capex, they haven't been able to pay down their debt. And that's probably okay because it's steadier cash flow. But I do believe in energy, in everything. No debt or less debt is better. So the pick of the litter here, I think, is Enterprise. They're the best situated. They're the best managed, I think. you get a 7% yield. Their control is with Dan Duncan's family. They are set up where the GP elects the board. I think, frankly, that's an advantage. I think you may get a more effective board that way. So if you were going to look at one of them, I think Enterprise always seems to be the best of them. The next page is Exxon, Chevron, Conoco, Oxy, Cheniere. Oxy is a large holding by Berkshire. Berkshire seems to be selling everything, but I mean, Apple, Bank of America, other things, they apparently are just going to sit with their Oxy ownership. There was some speculation that Berkshire would acquire all of Oxy, so it generates a lot of cash flow. They've said they're not going to do that, and I think we should take them at their word. These things, interestingly enough, trade a little higher enterprise value times free cash flow than, say, EOG or Magnolia or Antero or EQT, maybe even, well, they're a little less than Enterprise. They're good investments, but look at the difference in yield. I mean, in Exxon, you make 3%. In Chevron, you make 4%. In Enterprise, you make 7%. In Antero, you make no yield. Antero doesn't pay a dividend. The CEO doesn't think dividends make sense. When you get to EOG and Magnolia, you're down under 3%. Cheniere is interesting. It's very difficult to figure out what Cheniere is because they have a partnership. They are the largest. They're like half of the capacity, more than half the capacity to make LNG in this country and export it. But it is an interesting business. Hard to figure out. And that pretty much completes energy. All of you are muted. Any questions from Mike or Jason on the run through energy?
Not on my end.
No, I don't think so. I mean, we've talked about it's kind of hard to add new natural gas power production in the current environment. I don't know if you have any views or expectations that some of that might change with a different administration.
No, I think power is needed. If we go back to Exhibit B, the amount of gas used to make power was flat as a board for quite a while, but it's taken off recently. If you look at that power line, it was up 2.5 Bs in 23, and year to date it's up about 1.5. Have it up 1.5. Everyone says LNG. Well, if we look from 21 till this year, LNG has only gone from 11 to 13. So the power demand increased power demand has been more important for gas. I think gas is going to continue. Gas is the fuel that gives you 4-hour power. Wind and solar are not base load. So I think gas-fired power is good. I think the data centers, I mean, we might as well go to page 1. The data centers and the NVIDIA customers, the middle three there, Amazon, Alphabet, Microsoft, plus Meta, plus Oracle on page 2, Meta on page 4, since everyone's focused on the NVIDIA earnings call later today after the close. I get a question for Mike and Jason, which they may want to pass on and answer next week. But what portion of NVIDIA's revenues do you think those 5 account for? I mean, it must be more than half.
Oh, that's a good question.
I think it is just a little over half. Yeah. From just those, maybe even 4, the top 4 customers.
I think it's right. I haven't checked it. I read it. I haven't checked it. But the thing I read said that Microsoft, who's on a June 30 year, so they're 3 months to June 30 was their last quarter of their fiscal year, spent more money in that fiscal quarter than they spent any prior year in CapEx. The phrase that I keep thinking about the sales lift in NVIDIA is Sundar, if I've got his first name right, the CEO of Alphabet, saying that the risk of underinvesting is much greater than the risk of overinvesting. And I was talking to Mike this morning. I mean, when you look at Intel's predicament, and I guess you could say that they weren't. They did a lot of other things in addition to underinvesting, but here they were the dominant chip company. They were on page 3, and now it's not even clear whether they make it to the next decade. And look at their free cash flow. I'll update these numbers this week, so next week we'll see 6-month numbers. I don't think it's going to change too much. I mean, they just on a free cash flow basis, they are losing money at the rate of $15 billion a year. I mean, the debt is $48 billion. I mean, they're not going to be able to. I mean, they've done all. Plus, the debt's probably more than $48 billion because they've done all these off-balance sheet deals with Brookfield and others. So, I mean, At some point, Intel may have to be reorganized or something. I mean, you talk about it. I mean, NVIDIA 10 years ago probably had, I don't know, Mike or Jason have a better feel for this, but I'm going to say 5 billion of sales, something like that. And their current run rate, I have here at 110. I think people are projecting more than that for the next 12 months. I mean, so you've gone from 5 to 110, while Intel's gone from being our major chip company to, being maybe not able to make it through the next 5 years. I mean, so if you're Google or Amazon or Microsoft or whatnot, keep coming back to Sindar's comment, you just can't take a risk of underinvesting.
I think that's right. I mean, if you think about Intel's problem is they missed mobile, right? Notoriously, they had a deal on the table with Apple to do a mobile chip for the iPhone, but couldn't get it across the line because they looked, finance was sort of, the bean counters were running the show there. It wasn't about strategically what's important for the company as far as staying on the cutting edge of semiconductor manufacturing. So the bean counters won, they didn't do the deal, and the company remained very profitable for years thereafter. But now we're entering the second major technological shift to hit them, AI, right? Manufacturing GPUs, and they are definitely losing. Even SoftBank tried to do a deal with Intel on AI chips and couldn't figure out how to get anything done. Intel's trying to become a foundry, but they've never had a customer-facing culture, and they were unable to acquire Tower Semiconductor. They just don't have the parts available to them to run the type of business they need to run. And arguably, it's going to be very difficult for them to produce their own chips, even when they have all the new equipment from ASML up and running. There's no evidence that they will be any good at manufacturing that. Here's something that I read this morning. If you take the total employee count at Taiwan Semiconductor plus AMD, you have fewer employees than Intel has today. So that should tell you that Intel is probably way, way, way bloated for what it actually is. And the cuts and everything that Gelsinger made were probably way too few and way too late. Over a year ago, Jason and I were talking about how the debt at Intel was, it was AAA rated or AA rated, very good debt rating. And we're just sitting there scratching our heads. How do you see this company? It just doesn't make sense to have that much debt. And now you'll probably start to see some of that fall apart.
We shouldn't go too far further without seeing getting your judgment on what Microsoft, Amazon, Google, Meta, Oracle will do to try to create less expensive alternatives than $40,000 per hopper chip. Jason, how much progress? But Mike and I were talking, we were thinking maybe Google was the furthest along, but do you think that's feasible for these cloud companies to try to save some money by having their own chip designs made by TSMC, or how does that look to you?
Oh yeah, I think I would say yeah. Alphabet and Amazon are the furthest along, and they're absolutely going to do that, and it's in their interest to do that. I think since the creativity and the application of these AI models is, changing rapidly, you still want a GPU to run your training cluster. Because you don't know what the workload for training models will be next year or 2 years from now or 5 years from now, since that's their depreciation schedule. But once the models are baked, you know what the inference is like. So you know that you have this workload of generating search type results with a language model if you're Google. So you're going to make chips customized to that workload. And I think that's where the difference will be. So the inference will go to these custom chips, and then the training workloads, the big training clusters, will still be, these generalized GPUs.
And to add to that, Jason, all of these cloud providers it's in their best interest that the NVIDIA GPUs are also used for inference. But where they want to use their chips, their semiconductors, this is my assumption, is actually on the margin. You make the initial investment in the H100 cluster, for example, and then 2, 3, 4 years down the road, you don't want to buy more H100s necessarily because you know what the workloads are. And in that case, you can offload more to an in-house Amazon chip or an in-house Google chip. This is more so for Amazon than Google. Google's building more specific to TPUs and really trying to get users on the Google software stack and hardware stack, if you will. But it's in both of their best interests to have high utilization rates of their NVIDIA GPUs for at least the initial 5-year period so that they have great returns on that capital deployed.
And they're achieving that now today.
Mm-hmm.
Yeah. One of the things, Mike and Jason have done a great paper on the risks, key points on NVIDIA. It's on their website and part of their quarterly letter. But one of the things that's pointed to is energy availability. We believe that XAI, Elon Musk's startup, to try to copy OpenAI, is the only one that's built a GPU-specific center. I think the others, Amazon, Microsoft, et al., are taking the GPUs and putting them in existing data centers so that they can go to work right away. Those existing data centers are all hooked up with power and whatnot. Now, there'll be more power consumption, but as far as we can see in looking at the development of data centers, it doesn't look as though that will, impact, the market for NVIDIA equipment. We'll get into this next week, and we'll have the NVIDIA results later tonight. But I think a subject next week is how much other expenditures and IT budgets are impacted by people spending a lot of money on AI. It's got to have an impact. We're going to see it in other situations, including companies on the 80 pages. We'll get into that next week.
Okay, let's take a quick break for a message from Oak Cliff Sailing.
Hi, I'm Erin Coyne. I'm a boat captain at Oak Cliff, and filming me is Siri Shawns, who's our rigger. And in the world of Oak Cliff today, we are currently on the super yacht Sunlight. It's around 130 feet long, I guess. And today we're playing Sailmakers. They needed a repair on their left tape just to get through the rest of the season, so we're doing a little repair here. And if there's any other super yachts, Oyster Bay is a beautiful place to come. We have beautiful deep water and gorgeous natural scenery. And if anyone needs any crew for the bucket, please call Dawn and let her know, and she can help you out.
And now back to the show.
just before we break off, Jason, any healthcare news, Vertex or pharmaceutical or Lantheus or Harrow or anything last week?
I'll run through it real quick. So Lantheus's main competitor in the radio pharmaceutical space is Novartis. Novartis earlier this week announced that they're selling their European manufacturing network to Siemens Healthineers. So this is the network of radiopharmacies that produce the radioactive isotopes that go into these either diagnostics or therapies. So they're divesting of the manufacturing, but keeping all the IP and rights to the drugs that they've invented. So thought that was kind of interesting because we view Lantheus's network in the U.S. here as a strategic advantage, to having them as maybe one of the best radiopharmaceutical providers in the U.S. So that's an update on their competition at least. And then BioNTech, they just launched a clinical study on their experimental mRNA lung cancer vaccine. So it treats non-small cell lung cancer. It's similar to the COVID vaccine in that you'll get the mRNA infusion. In this case, I believe it's in an IV. It'll instruct your body to create proteins that mimic the lung cancer cells themselves. So your body mounts a big immune response against those proteins that were created through the vaccine, in the hopes that it sweeps up the rest of the tumor cells that are living within the lungs. So that's interesting. It's just started. It'll be 130 patients. It's a combination therapy with another drug that prevents the cancer from essentially hiding from your immune system. So it'll take away the cancer's defenses and then stimulate an immune response within your body. So they've said this is a phase 2 study. They said the early stage studies had really promising results. So it'll be interesting to follow this. It's a longer study though, over 3 years. So it might be a while before the results are read out, but could be very impactful.
Anything else, Mike?
I think that's it. Keep an eye out for NVIDIA's guidance. I mean, I think what you were saying before on NVIDIA is right. As of right now, the new data center capacity isn't a limiting factor. Actually, one thing I would add to that is that a lot of that is actually existing data center getting more efficient by transitioning old x86 chips to new ARM chips in some ways. So you can transfer that power requirement by running more efficient chips. Just to jump in, you can replace an x86 chip with an ARM-based chip that's much more powerful but uses the same power consumption.
Mm-hmm. Yeah. It's, we agreed amongst the three of us not to talk politics on these podcasts. I think from now on, we won't talk too much about Intel.
We're beating a dead horse, I think.
Yeah, we're gonna focus on the positives and not the negatives.
Yeah,
and we'll be here exactly 7 days from now. Everyone be well and stay healthy. Take care.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.